$900 billion. That is not a theoretical figure. That is not a rounding error in a Congressional Budget Office projection. That is the wall of commercial real estate debt maturing in the United States this year alone. It is a mass of concrete, glass, and steel that requires refinancing in a world where the cost of money has tripled and the value of the collateral has evaporated. But you aren't a commercial developer. You don't own a skyrise in San Francisco. You own a 3-bedroom in the suburbs, or maybe you're trying to buy one. You think this $900 billion bomb is contained within the blast radius of private equity firms and pension funds. You think your 3% mortgage is a shield. It isn't a shield. It is a prison cell. While the news focused on the noise of election cycles and the shiny distraction of artificial intelligence stock valuations, the real money was doing something much quieter and much more terrifying. The real money was bolting the doors shut. We are witnessing the beginning of the great liquidity freeze. This is not a crash where prices plummet overnight and scavengers feast on the carcass. This is something worse. This is a market that simply stops. A cardiac arrest of the entire housing ecosystem. The exit signs are lit, but the doors are painted on the wall. To understand why you cannot leave and why no one can enter, we have to strip away the Zillow estimates and look at the engine room of the financial system. It is broken. The mechanism is technical, boring, and designed to make your eyes glaze over so you don't ask questions. But today, we look at the gears. It starts with the bid-ask gap. In a healthy market, a seller wants 100, a buyer offers 98, and they settle at 99. That is price discovery. That is liquidity. Right now, the seller, anchored to the peak valuations of 2021, wants 100. The buyer, crushed by 7% interest rates and stagnant wages, can only afford 70. There is no middle ground. The gap is too wide to bridge, so the transaction doesn't happen. Volume collapses. This is the lock-in effect weaponized. Millions of Americans are currently sitting on sub 4% mortgage rates. They cannot sell. If they sell, they trade a $2,000 monthly payment for a $4,500 payment on a worse house. They are mathematically paralyzed. They are not homeowners anymore. They are asset custodians for the bank, serving a sentence until rates drop. And rates are not dropping to 3%. Not without a catastrophe that burns the rest of the economy down first, but the trap goes deeper than your monthly payment. It leads us back to that $900 billion wall. Who holds the debt for that collapsing commercial real estate? Who lent the money to build the empty office towers and the deserted strip malls? Regional banks. The same banks that issue the vast majority of residential mortgages and construction loans in this country. Their balance sheets are currently stuffed with unrealized losses. They are holding bonds and loans that are worth 40, 50, 60 cents on the dollar. But as long as they don't sell them, they don't have to admit they are insolvent. This is where the reverse repo market and yield curve control enter the nightmare. The Federal Reserve has drained trillions in liquidity from the system to fight inflation. The excess cash that used to slosh around, allowing banks to take risks on you, is gone. The banks are now in survival mode. They are hoarding capital to absorb the blow from the commercial real estate crash that is already happening in slow motion. When a bank is scared of insolvency, it does not lend. It tightens standards. It demands higher down payments. It scrutinizes your income. It lowers appraisals. This is the liquidity trap. Even if you want to buy, the bank won't give you the money. Even if you want to sell, the bank won't give the buyer the money. The gears grind to a halt. We have seen this movie before, but the lighting was different. To understand where this ends, we have to look at 1990. Not America, Japan. In 1989, the land under the Imperial Palace in Tokyo was valued higher than all the real estate in the entire state of California. It was the greatest asset bubble in human history. The Japanese believed land prices could never fall. They believed the liquidity would never dry up. Then the Bank of Japan tightened the screws. The bubble burst, but it wasn't the crash that destroyed a generation. It was the aftermath, the lost decades. Prices didn't just correct, they entered a slow, grinding, deflationary death spiral that lasted for 30 years. Zombie banks, insolvent but kept alive by government lifelines, refused to lend, Zombie companies refused to hire, and homeowners found themselves trapped in negative equity for the rest of their working lives. In Japan, they have a word for these abandoned homes: Akiya. There are millions of them, free to anyone who wants them, and still no one takes them. Because an asset with no liquidity is not an asset. It is a liability. We are flirting with a Japanese-style stagnation, but with American violence. In the US, we don't do gentle stagnation. We do leverage. We do derivatives. We do 97% loan-to-value ratios. When the liquidity dries up here, it doesn't just result in empty houses. It results in social fracture. So, what does the next 24 months look like? Let's project the forward scenario. Phase 1 is the standoff. This is where we are now. Sellers refusing to drop prices. Buyers refusing to overpay. Volume hits multi-decade lows. Real estate agents leave the industry in droves. Mortgage brokers pivot to selling insurance. The industry shrinks. Phase 2 is the gating. We've already seen the cracks. Major institutional funds, the ones who bought thousands of single-family homes, start limiting investor withdrawals. They can't sell the houses fast enough to pay back the investors who want out, so they lock the gates. This traps billions in capital. It creates panic. If the smart money can't get out, what chance do you have? Phase 3 is the forced capitulation. This is the trigger. It comes from the labor market. As the interest rate lag effect finally hits corporate balance sheets, layoffs accelerate. The soft landing narrative evaporates. When a homeowner with a 3% mortgage loses their job, the math changes. They don't sell because they want to move. They sell because they have to eat. Inventory spikes, but there are no buyers. The banks, terrified by their commercial real estate losses, have shut the lending window. Cash buyers, the private equity firms, step back, waiting for the bottom. They smell blood. They wait for the desperate. Prices begin to gap down. 10%, 20%. Suddenly, the equity you thought you had, the equity you borrowed against to buy a car or renovate the kitchen, is gone. You are underwater. You are trapped not just by your rate, but by the principal. You cannot sell without bringing a check to the closing table. And here is the kicker. The government will try to intervene. They always do. They will introduce 40-year mortgages. They will offer forbearance. They will try to print their way out of the liquidity trap. But you cannot print confidence. You cannot print a buyer for a house that is overpriced by 40% in a high-rate environment. The $900 billion commercial collapse is the catalyst. It destroys the balance sheets of the lenders. Without lenders, there is no housing market. There is only a collection of expensive boxes that no one can afford to trade. The illusion of the last 3 years was that real estate only goes up. The reality of the next 3 years is that real estate is an illiquid trap when the credit cycle turns. You are looking for the exit, but the architecture of the market has changed. The hallway doesn't lead outside anymore. It leads deeper into the labyrinth. The liquidity is gone. The doors are locked, and the bill is coming due. History doesn't repeat, but it rhymes. Subscribe to see the pattern.